Thank you so much for the introduction and also for inviting us here. It is a tremendous pleasure to be here with you in Bangkok today, in this incredible city with such wonderful food. So it's a great pleasure to come here to Thailand, and thank all of you for coming here this afternoon. So I look forward to having a discussion with you about the global economy and how it impacts the various markets that trade at our exchange. So at any point during the presentation, if you have questions, just raise your hand and I will do my best to answer your question right away. I look probably to speak for maybe 45 minutes or so, possibly a little bit longer. And then we can have a broad discussion and Q&A. I'm also very curious to know what your views are. As many of you know, CME Group is the world's largest and most diverse derivatives exchange. We began in agriculture 160 years ago or so with futures on corn and wheat. Later on that expanded to include soy. By the 1960s it began to include things like animal products on beef and pork. And then during the early 1970s a number of things happened. The world had been on a system of fixed exchange rates that came to an abrupt end in the early 1970s, which caused gold prices to begin to soar. Currencies began moving against one another, and at that point it created a great deal of financial innovation. So now we have futures contracts on gold, silver, platinum, palladium, and copper, on oil, other energy products, on currencies, on government bonds, as well as a number of other products, and very soon Bitcoin as of December 18th. So one of the great pleasures that I have of working as an economist at CME Group is that it affords me the opportunity to study how the products that trade on our exchange influence economies around the world and how they are in turn influenced by the economy. So sort of the feedback loop between, say, energy and the economy, how they influence one another, or how interest rates influence the economy and in turn are influenced by the economy, as well as how different products correlate across different asset classes. It's sort of one big economic system. So before we get into the details of the presentation, I am required by my compliance department to show you both this short version as well as this longer and much more involved version of our disclaimer, which basically says that because we are an exchange and not an investment bank or not a broker-dealer, I cannot make any trade recommendations. So if you wind up losing all of your money on our new Bitcoin future, please don't sue us. Yes. So I thought I would begin by talking about something that is specific to a number of products, but also sort of emblematic of what's going on in the global macroeconomy. And that is the absence of volatility across most of our products. This chart here shows the implied volatility on options on our silver and gold contracts. And so when that number is high, it means that people expect a great deal of volatility in the future. And when it's low, like it is now, that means people don't expect to have very much volatility. And so you can see very clearly for silver and for gold, implied volatility is trading at historic lows. And that's true for many other products that trade on the exchange. It's true for almost all of our currencies. We have 6 major currency pairs that trade on the exchange, as well as about 10 other currencies that trade in smaller volumes but still trade. These are 2 of the biggest currencies, the euro versus the US dollar and the British pound versus the US dollar. And what I think is interesting about this is 2 things. First, as you can see, the implied volatility on currency options, like for gold and silver, is near the bottom end of its range. But what's particularly interesting about this, though, is that Europe and the United States both have a lot of problems that you would think might cause people to worry and might make that level of implied volatility higher rather than lower. For example, the British are, of course, discussing their exit from the European Union, and these discussions are not going very well. Theresa May, the Prime Minister's government, might collapse very soon, and they could have new elections within 6 or 12 months. They could bring Jeremy Corbyn and the Labour Party back to power. Within the Euro area, you have Angela Merkel, who is still the Chancellor of Germany, and is trying to have a very difficult time putting together a government for her country after the most recent elections, which were fairly indecisive. On the other side of the Atlantic Ocean, we have Mr. Trump, whose administration, I think it's fair to say, is off to a very difficult start. He has a 38% approval rating, which is not very strong for somebody only 1 year into their first term as president. The Republicans are attempting to pass a tax bill, which they seem to be getting through, but it's not a done deal yet. But if they manage to get that tax bill through, it could lower corporate tax rates a great deal, which could bring a lot of money flowing back into the United States and into the US dollar. And so that could create volatility. And yet, in the markets, there's a strange lack of concern. Nobody really seems to be nervous about any of these political developments. And the same thing is true when you look at the US bond markets. We have futures all across the yield curve in the US. We have 2s, 5s, 10s, 30s. I just put a few of the futures up here, about three of the 6 major futures. They too are trading at near record low implied volatilities. And the same thing is true, of course, of the equity market in the United States. The equity market has the longest time series of implied volatilities, and there's a very famous index of volatility on the S&P 500 called the VIX, which goes back really to 1993, and you can find information on it as far back as 1986 on Bloomberg under a different code. You use VXO instead of VIX. So this has over 30 years of history. And what we find now is that we are trading at record low volatility here too, around 8, 9, 10% implied volatility. Now, what's very interesting about the volatility in the market, and we'll explain, is that it's very cyclical. And the market seems to really have 2 phases of volatility. It has a very low volatility state, like it was in here during the mid-1990s, like it was in around 2003 to 2007, and like it has been really since the end of 2011. And during its low volatility state, the VIX averages around 14% implied volatility. So the market has very, very, very small moves day to day. And so the markets are just extraordinarily calm. But the VIX also has another very different state, which is a much more agitated state, where it is on average 2 or more than 2 times as volatile. And so we were in that more volatile state from 1997 to 2003, and then again from 2007 to 2011. And so one of the questions that many people have is, why is it that volatility is so low? Well, there's a couple observations we can make about that tell us a lot about where the U.S. is in its economic cycle, and then we can apply that idea to other countries to see where they are in their respective economic cycles, which may help us to be better investors, whether we're investing in commodities, equities, bonds, or currencies. And so one observation that I think is pretty easy to make is that when corporate earnings are very high and growing, volatility tends to be low. Yeah, it was true here with low volatility. It's been true here with low volatility. But when corporate earnings begin declining, often you shift into this higher volatility state. But that doesn't really answer fully the question of why volatility is so low. And I think the reason why volatility is so low right now across so many different markets in so many different countries is that central banks have created enormous amounts of liquidity. And so here we see just 3 central banks, the European Central Bank, the US Federal Reserve, and the Bank of Japan, all of which have vastly expanded their balance sheets. But in addition to those 3 banks, there are many other banks around the world that have interest rates that are low by historical standards for their respective countries. You see that, for example, in Sweden and Switzerland. You see that in Australia and New Zealand. You see that here in Southeast Asia. You see that in China, where interest rates are relatively low by historical standards. You see that in Korea and many, many other countries. And so one of our hypotheses, and we'll test this in more detail with some very strange, very weird charts in a moment, but one of our hypotheses is that when central banks create a great deal of money, that some of that money, in fact, most of the money finds its way into financial markets. And when there's a great deal of money available, it makes it very easy for buyers to find sellers and for sellers to find buyers. And so in order to get sell and buy orders filled, prices don't have to move very far. And so realized volatility in the markets tends to be very, very low. And so that explains in part why we're going through such a calm period in markets. However, when central banks begin to withdraw liquidity from the markets, there can come a point when somebody tries to sell something, whether it's gold or silver, whether it's stocks in the US, or whether it's the Thai baht in 1997, and there are no buyers at that given price. And so you can see a very, very big, very violent adjustment in prices and see a huge expansion of market volatility. And so the question that we have is, when is this next period of high volatility likely to come about? And that's the question that we will seek to answer, because that answer to that question will affect so many different markets that we all trade in, whether you're in Thailand or whether you're in Europe or the United States. And so if you want to know when the next volatility explosion is going to happen, the answer is right here on this chart, which I would admit is the strangest chart that I have ever produced. But let me explain what it is, and then we will break it into pieces and explain it in much greater detail. And it will tell you more or less when the next volatility explosion and when the next credit spread explosion is likely to occur. So what this is three separate cycles over about a 30-year period of the relationship between the shape of the yield curve, which is a measure of the easiness or the tightness of monetary policy, and the level of volatility. So essentially, we have a 2-year moving average of the VIX index along the x-axis and a 2-year moving average of the yield curve along the y-axis. And so when you break it down into cycles, what you get is something that looks like this. This is the first cycle, which took place between 1990 and 2000. And so we begin in 1990 and 1991. Most of you are probably too young to remember, but not all of us. In 1990 and 1991, in the US, we had a very flat yield curve. The central, which means the short-term interest rates were about the same level as long-term interest rates. And that's very bad news for the banking system, is the way in which the banking system makes money is mainly to borrow short-term at a low cost and to lend long-term at a higher cost. And so when the yield curve is steep, when short-term interest rates are low and long-term interest rates are high, the banking system makes money very easily and without a great deal of effort. But when the yield curve becomes flat, the banking system stops making money. So in the late 1980s and early 1990s, we had a savings and loan crisis in the United States. And so we had very high volatility in the equity markets, and we had a very flat yield curve. So what did the central bank do? Well, the central bank dramatically reduced interest rates. In 1989, the Fed funds rate was at 9.75%, which is difficult to believe by today's standards. But by 1992, they had that rate down to 3%. So they cut interest rates from almost 10% down to just 3%. And the effect that had was to dramatically steepen the yield curve in the United States. But with a steeper yield curve, the banking system became profitable again. It began lending money. The economy started to recover, and then the equity market became much, much more calm. So we had much lower levels of implied volatility. So by 1994, the central bank had regained confidence that it could raise interest rates. So it took interest rates from 3% eventually up to around 5.5%. And that had the impact over the next few years of dramatically flattening the yield curve. But with a very flat yield curve, by 1997, right around the time the Asian crisis began here in Thailand and quickly sped to many other countries, and then to Russia in 1998, and then to the American hedge fund, long-term capital management, in August and September of 1998, we had this explosion in volatility. And so by 2001, we had, once again, a very flat yield curve, so the banks were not making very much money, and we had very, very high volatility. And so the U.S. economy went back into a recession. And that recession we remember as the tech wreck. It was a bad time to own technology stocks. The NASDAQ index of equities fell by 85%, which is an enormous, enormous decline. And there was a big drop, particularly in business investment. And so the central bank responded once again by lowering interest rates, this time from 6.5%, eventually down to just 1%, which dramatically steepened the yield curve. And as a result of that, we had a tremendous compression in volatility. So by the middle of 2004, the central bank started raising interest rates again because we had a recovering economy. And by 2006, it flattened out the yield curve. And what could go wrong, right? Well, as we know, everything went very, very badly after that. With a flat yield curve, the banking system could no longer make money. The housing market began to turn down. And so by 2007 and 2008, the U.S. was in the midst of an enormous real estate and banking crisis that caused this tremendous explosion in volatility. And so where are we today? Well, in the current cycle, of course, the central bank, as we know, cut interest rates this time to almost zero, down to just 12.5 basis points, which eventually, over time, managed to reduce volatility until we found ourselves eventually with a very steep yield curve and very low volatility. Now, the central bank is beginning to raise rates. They've raised rates already 4 times, and they're going to raise rates once more, I think, almost certainly later this month. I think it's December 13th, if I remember correctly, their meeting. And so right now we find ourselves right here. So we still have about 150 basis points of steepness between 3-month and 30-year. And that's probably enough to keep things very, very calm in the markets for probably another 12 months, maybe even another 24 months. So we could be looking at a 2018 that has very calm markets still. In some ways, if you look at this point right here, and you look at it for the previous 2 cycles, it looks a lot like 2005, or maybe early 2006. In 2006 was a very boring year for the markets. Equities continued to go higher. Credit spreads remained narrow. There weren't a lot of obvious problems. There were a lot of problems happening underneath the surface, but everything seemed to be going quite well. It's also very similar, to where we were around 1995 and 1996. So the equity market continued to rise after that for several years. The economy continued to expand for several years. So based on this position in our VIX yield curve cycle, we think that we are probably towards the mid to late stages of an economic expansion in the U.S. We think it probably has further to go. But before we discuss the details of exactly how much further to go, I'd like to introduce one other concept, which is the exact same idea as before, but this time it measures the relationship between credit spreads and the yield curve. So credit spreads, we take a high-yield corporate bond index, which is managed by Credit Suisse, and measure its option-adjusted spread over the U.S. Treasury index of similar maturity. And we find the exact same pattern. When the yield curve is very flat, we tend to see an expansion of spreads, which chokes off credit to the corporate sector of the economy. Then we tend to see a steepening of the yield curve, which in turn brings spreads back down and allows the economy to grow. But that in turn, eventually causes the central bank to begin raising interest rates again, which flattens the yield curve, which causes another explosion of spreads. And so right now we find ourselves right here, which is in almost exactly the same place as we find the yield curve and the VIX, which is to say that we have a flattening yield curve, but one that's not all the way too flat. 156 basis points of spread is more than enough to keep the banking system sufficiently profitable to continue lending money. So we think this expansion will continue in 2018. But we think that the risks are building, that something very, very big is going to happen maybe later this decade in 2019, or more likely perhaps in the early 2020s. And so really the answer to how long this continues is in the hands of the Federal Reserve. Now, the Federal Reserve, as you know, is having a new person coming in to run it, a man named Jerome Powell. But Jerome Powell is close friends with Janet Yellen and is very ideologically similar to Janet Yellen. So we don't think that he really represents a very big change from her monetary policy. Now, in addition to a new chairman, there are many other new members coming in at the Federal Open Markets Committee. And so these new members tend to be very different than the existing members in the sense that most of them are lawyers or business people and not professional academic economists. Now, we don't know exactly what that means for monetary policy, but we're going to find out. And so if you look at the Fed's dot plot, which tries to forecast by the Fed's own member where monetary policy will be in the future, that dot plot suggests that in addition to hiking rates one time later this month, that they will hike rates 3 times next year and 3 times the year after that. So after the end of this year, that's another 1.5% or 150 basis points of further rate hikes. If they do that, by 2019, they will probably have that yield curve all the way to flat. And in turn, that will probably, in the early 2020s, meaning the very early 2020s, like 2020 or 2021, produce an explosion in volatility and an explosion in credit spreads that will put the world markets back into a much more volatile and disjointed state, much like they were in during the late 1990s and early 2000s, and much like they were in around the time of the U.S. financial crisis. On the other hand, the market does not believe the Fed's dot plot. The market prices a very, very different scenario. The market prices basically that the Fed will hike again in December. They'll hike one time next year and just one time the year after that. So if the Fed hikes, say, just 50 basis points over the next 2 years, that could keep the yield curve more or less where it is today, with sufficient steepness to keep the current economic recovery going. And I think that there's a strong argument in favor of them not increasing interest rates too much. And the argument is that, first of all, even though unemployment in the United States is very low now at just 4%, there's no obvious wage pressure. And since there's no obvious wage pressure, why should they be concerned about inflation? And if they're not concerned with inflation, why should they be raising interest rates so much? It doesn't really make sense. So I tend to think that they're more likely to go slowly than quickly. And if they go quickly, it's because they're making a policy error. Now, we know that central banks can and do make policy mistakes. And we don't know how this new group of people coming at the Federal Reserve will behave. But we're going to start finding out early next year. Jerome Powell takes over the chair in late January or early February, and most of the other new members are in the process of being appointed right now. So in 2018, it will be very important for all of us to watch how they're behaving. Are they increasing interest rates a great deal, more than the market expects? If they are, this is going to create very big problems for the world economy and for the U.S. economy. The central bank in the U.S., even though the U.S. economy is maybe not as important to the world as it was 10 or 20 years ago, is still very influential. And part of that influence is because so many other countries link their currency to the U.S. dollar. Some of those countries do it in a very explicit fashion, like the countries of the Middle East, like Kuwait and Saudi Arabia and the United Arab Emirates. In other ones, in a more indirect fashion, like the Chinese. The Chinese allow their currency to have a small variation and a very controlled variation against the US dollar. But essentially, if the US dollar moves upwards because the Federal Reserve is raising rates, that's likely to cause the renminbi to also move upwards, which could be very problematic for China and for its competitiveness. And we'll discuss China in much greater detail in a few minutes. Now, the good news, though, is if you look at other countries and where they are in their cycles, almost every major economy also has a positively sloped yield curve. And so I'm very, very optimistic about Europe. Europe is in an earlier stage of its economic recovery than the US. The US and Britain have been growing now for about 8 years, whereas the Euro area has really only been growing for about 4 years or so. And so they're in a much earlier stage of their economic recovery. So I'm very optimistic that they will continue to grow and will have a very, very good year in 2018 and probably in 2019 as well. The same thing is true of the United Kingdom. The United Kingdom, for example, also has a positively sloped yield curve. Some people ask, well, will Brexit cause a recession? I tend to think the answer to that question is probably no. And the reason is that even in the worst case scenario that they have a hard Brexit and the trade barriers go up, that's obviously negative for the United Kingdom. On the other hand, their currency will drop very, very precipitously if that happens. And the fact of a lower currency, of course, protects them from cheap imports and also subsidizes their exports to the rest of the world and can help to offset the negative political consequences of Brexit. On the other hand, if they have a soft Brexit, or maybe if the Labour Party wins and they maybe negotiate a deal that's so bad that nobody will approve it, so they put it to a vote, they could even decide to remain in the European Union. Who knows? It's possible. In that case, I think the currency goes way up, which also offsets any of the benefits of staying in the European Union or having a European Union-like arrangement outside of it, like Norway or Switzerland have. I'm quite optimistic about the United Kingdom, and the truth is that most other countries in the world have positively sloped yield curves. So I think that the synchronized global recovery probably has at minimum another 12 months in it, maybe even another 24 months before we really have to start asking questions about what central banks are doing and whether they'll derail that recovery and cause another crisis. But there is one country that I'm very, very concerned with, and that's China. China, as you know, is an enormous economy. It's 5 times bigger than India, 6 times bigger than Brazil, 7 times bigger than Russia. So, as everybody here in this region in particular knows, China has an outsized influence on the direction of commodity prices. And that's especially true of the prices of industrial metals, where China is the world's largest consumer by far, taking 2/3 of the world's iron ore and maybe 40 to 50% of many of the other industrial metals. But China also, of course, has a big influence on many other products, on agricultural goods, on energy. And of course, there was that day a little bit over 2 years ago in August of 2015 when China devalued its currency by 4%. And that sent shockwaves through bonds and equity markets around the world as well. So one thing, there's a couple things that really worry us a great deal about China. One of those things is their level of debt, which I think has gotten a great deal of attention, but I will reiterate it just briefly, which is that back in 2008, when the rest of the world experienced a financial crisis, especially the U.S. and Europe, debt levels in the U.S. and Europe at that time when the financial crisis began were around 250% of gross domestic product if you add up the public and the private sector debt. China's debt at that time was very low. It was only 140% of their gross domestic product. And so China had this problem. And the problem, I think, was pretty simple. Under the Communist Party, they basically had 2 phases. They had the Mao Zedong phase, which was an economic disaster, with the Great Leap Forward, the Cultural Revolution, all sorts of upheaval that did not generate a great deal of value and in fact destroyed a great deal of their economy. And then they had a different relationship since 1979 from Deng Xiaoping onward. And the Chinese Communist Party basically has an unspoken agreement with the Chinese people that they can maintain their monopoly on power in exchange for very rapid increase in the standard of living. And so as China began to slow down, the Communist Party said, well, we have to get growth rates back up. So they encouraged their private sector to start lending a great deal. And so they encouraged this huge round of investment. And they were very successful. They got the growth rate to go from 5% back up to over 10% for a few years. But then as debt has continued to accumulate, the growth rates have slowed down. And so what China is experiencing is something that many other countries have experienced, which is that when debt levels are low and somebody borrows money, it very quickly adds to GDP because my spending becomes some revenue for somebody else, either investment or spending, so it adds to gross domestic product. But as debt levels go higher, additional borrowing mainly serves to finance the existing debt and stops adding to domestic output. And so that's the point at which China has now reached. And we think that this is a very dangerous point for them. The other thing that concerns us about China, going back to our discussion of the yield curve, is that the yield curve in China has become almost completely flat, with very little difference between short-term and long-term interest rates. Now, many people are surprised to know that there is in fact a yield curve in China. And it's in fact a more recent development in China than it is in other countries. But as we showed for the United Kingdom and for Germany, for the United States, for many other countries, the yield curve is the best indicator of economic growth going forward. And so the fact that China has a very flat yield curve is an indicator that Xi Jinping's administration is actually somewhat successful in encouraging a crackdown on further growth in China's debt level. But the problem is that this could create an enormous slowdown in China's economy. And if you look at the correlation between the shape of the yield curve here in blue and the GDP growth rate here in black, this is what you find. You find that there's a correlation that becomes very strong, over 0.7%, if you look at it 3, 4, or 5 quarters in advance. So essentially, a flat yield curve right now doesn't really mean much at all for the GDP growth rate. But it means a great deal potentially for that growth rate in 9 months, in 12 months, or in 15 months. So the fact of China having a very flat yield curve today doesn't mean much at all for their growth rate this quarter. They may continue to post growth rates of 6.5% to 7%. But as we get into 2018, the likelihood that China experiences a very severe slowdown are beginning to grow. And if China experiences a slowdown, yes?
So how do you reconcile the fact that China has a flat yield curve, but if I look at the Shibor rates, it's relatively steep between the overnight and the 1 year, for example?
Yeah, so I guess they have like a sharp, kind of like maybe the market's anticipating that the central bank will hike rates over the course of the next 12 months. And that the rest of the curve thinks that, okay, well, after those rate hikes go through, interest rates are likely not to go very much higher. And I think that that point right there is very interesting because I think markets anticipate when you have very high debt levels that interest rates can only go up to a certain level. We see that in the United States. I didn't put the graph for U.S. debt levels in here. The U.S. debt levels are very similar to China, but the difference is they've been at 250% of GDP for a long time now, since 2007. And so in the U.S., the Federal Reserve's been hiking rates now 5 times. The market thinks they'll go further. And yet you still have 30-year bonds trading at only, around 3% yields or something like that. Very low yields. And so I think that the markets kind of have a collective realization, more or less an unspoken realization, that when you have massive levels of debt, the central bank can only take up interest rates so high before it creates really big problems. So I'm concerned that if especially if PBOC decides to hike rates, as the Shibor curve would suggest, that could help to bring about a very steep downturn in China. And so, if you look at the correlation between industrial metals prices and say Chinese GDP growth, you see that there's a very strong relationship. So one of the things I'm most concerned about in the event that China does slow down is copper. Copper, iron ore, those sorts of metals we think could also really take a big hit to their value. Another thing that concerns me a bit about China is that there are so many emerging market currencies that are closely tied to the value of commodities. And so if the Chinese economy slows down and industrial metals prices start to fall, if the value of other commodities begins to fall, then we think one of the risks is, in that case, that all of their currencies begin falling as well. And so China has been in this really nice period for the last, say, few months, the last 12 months or so, where they have stopped selling their foreign reserves. Their foreign reserves peaked out at $4 trillion, and then they fell to $3 trillion, which is still an enormous amount. But then they've been kind of stable at around $3 trillion for the last 12 months or so. And I think a lot of that has to do with the fact that many other emerging market currencies rebounded. You had a huge rally, for example, in the Russian ruble, the Brazilian real, and all of this took pressure off of China. And I think a lot of this was related to this little uptick we've had in Chinese economic growth. Back here a year ago, many people were afraid that this would continue to slow. But as he went for his second mandate, Xi Jinping managed to stimulate the economy ahead of achieving that mandate. But now that he's back in power for another 5 years, I think the likelihood is they'll pull off that stimulus. And a steep Shibor curve is actually an indicator that the market believes that they will pull off that stimulus. Whereas the flat rest of the yield curve from 3 years to 10 years is an indicator that the economy might be in the process of slowing down. So if all of this goes down, I think that what will happen is emerging market currencies will fall, commodity prices will likely start falling again, and that China will eventually find itself in a position where there is more downward pressure on its foreign reserves that eventually, maybe sometime in 2019 or 2020, essentially forces their hand and they have to devalue the renminbi or allow it to trade more freely against other currencies so that it can fall. Because I think China's running into some pretty severe competitiveness problems. I didn't put in all of the charts, but basically you can find charts that show the relationship between basically every commodity exporting country and some commodities. This is it for Canada versus oil. Very similar for Russia versus oil prices. And a very similar chart you could draw between the Australian dollar and copper or iron ore. The same thing for Brazil and various industrial metals. So if those prices start going back down, watch out. It's going to be very bad news for China. So we'll have to see what's going to happen. In terms of oil prices, while we're on the subject of oil, the oil curve is very flat. Essentially, the market prices that oil prices will remain near $55 per barrel for at least the next 2 years, and then some of the curves even go out further than that. For example, the December future on West Texas has some liquidity out to the year 2025. And it shows very flat oil prices. So if you look at that, you could conclude that, well, the oil market doesn't have a great deal of risk. But we'll see. Options on oil, like for many other commodities, are also declining in implied volatility. But unlike the other commodities, which we saw were all trading at record lows, oil is actually still around 23%, 24% implied volatility, which is quite a lot higher than it was before its collapse in prices. But when I look at this, it makes me a little bit nervous, especially when I see production constraints in the United States, as well as the potential for volatility and the potential for problems in Saudi Arabia in particular. And we'll talk about Saudi Arabia more in a minute. So if you look at the oil production worldwide, what's very interesting is that if you just exclude the US and Canada and you look only up to the light blue part, outside of North America, production growth has been almost non-existent since 2004. So almost all of the additional growth has come from the United States and from Canada. And so I think the markets are very hopeful that the United States and Canada can offset problems elsewhere in the world where there would be some impairment to production in other countries. But I think that this hope is sometimes a bit misplaced. Now, it is true that when OPEC cut production by 1.5 million barrels, the United States was able to raise production by 1.5 million barrels and keep the market more or less stable and in equilibrium. But we're not sure for how much longer that will last. And one thing that really concerns us in particular is Saudi Arabia, which is still one of the world's biggest producers with about 10 million barrels per day. If you look at Saudi Arabia's foreign exchange reserves, they've been declining very, very consistently now for the last several years. And they continue to fall even though oil prices are still a bit higher now than they were at their absolute lowest point. And so we think the declining reserves in Saudi Arabia explain a lot of the politics and economic policy that's being developed in Saudi Arabia. So as I'm sure you all know, Saudi Arabia wishes to open the capital. I hesitate to say privatize because it's not a privatization, but it's a capital opening of Aramco, which is by far the world's largest and richest corporation. In theory, the Saudis think that Aramco has about a $20 trillion value, which is just an astonishing number. It would be like if you took Facebook, Apple, and Amazon, combined them together and multiplied them by 7 or 8. Just an astonishing value for this enterprise. But they've been having a lot of trouble as they bring it to market. And so part of the trouble is that potential investors in this enterprise are not willing to pay as much as the Saudis think that it's worth for a variety of reasons. For one thing is, I'm sure anybody who went to a business school here knows, is that people tend not to pay as much for minority stakes in enterprises because they don't have control. So if you wanted to, say, buy out Phillip's Capital, you would have to pay a significant premium above the market price. Maybe 35, 40, 50%, whatever the management and shareholders would accept in order to take it out, right? And so with Aramco, they're only opening 5% of the capital. And unlike most private sector businesses, Aramco is a very, very opaque enterprise. It doesn't account for its profits and losses in the same manner as other enterprises. It doesn't have an independent board of directors. And in fact, it's basically a part of the Saudi royal family and the Saudi state. And so as they attempt to bring it to market, they're running into a lot of problems. And so then a few weeks ago, you had this strange series of incidents in Riyadh, where on the same night, some Houthi rebels in Yemen fired a missile towards Riyadh that was apparently intercepted. Then a helicopter carrying the son of the crown prince, Prince Mansour, the former crown prince, I should say, who was pushed aside recently, was shot down and he was killed, or it fell because of mechanical failure. Then 11 prominent princes, including some very, very prominent ones, Mr. Al-Walid, who is one of the world's most famous investors, were arrested and imprisoned at a very luxury hotel. I think it was the Crown Plaza, if I remember, or the Ritz-Carlton. The Ritz-Carlton, yes. There are worse prisons, I'm sure. And then along with 40 ministers, 500 other people. And so most of them are now out of jail, but they had to fork over 70% of their assets in order to get out. And I think that that's very closely related to this chart. Saudi Arabia needs money. And they need money very, very quickly. And so this is very interesting politically. There's also a lot of other things happening in Saudi Arabia and the Middle East that I'm sure you're aware of, including them cutting off diplomatic relations with their former close ally Qatar. And they're fighting proxy wars both in Syria and the Yemen with Iran. And so the Crown Prince is trying to modernize Saudi Arabia very, very quickly. And making big changes can be dangerous for a variety of reasons. So First, he's trying to pull back on the Wahhabist religious police and allowing women to drive cars, which I think most of us would agree is probably a very, very good idea. I mean, I don't know what the statistics are here in Thailand, but I can tell you in the United States, women are much better drivers than men. So allowing women to drive is probably just in the interest of public safety. But my analogy would be this. If you go back 35 years, or rather 32 years to 1985, to a very different country, to the Soviet Union. At that time, they had a new leader, Mikhail Gorbachev, also very young, a reformist. And Mikhail Gorbachev introduced a series of reforms that were very well received in most other countries. He introduced glasnost and perestroika. And glasnost was meant to open up the country politically so that people could start saying whatever they wanted to after 60-some years of communism at that point in time. And then perestroika was meant to reform the economy. And so these were greeted very positively in most Western countries. And are still thought of positively in most Western countries. But when you have a very repressed society in which people don't have a tradition of being free, and you suddenly start giving them a little bit more freedom, very unpredictable things can happen. So within 4 years, the Soviet Union had lost control over Eastern Europe, and then within 6 years, it voted itself out of existence. So the truth is that allowing women to drive in Saudi Arabia is probably not of a lot of political consequence, but the Wahhabist religious police also play other roles. Saudi Arabia produces most of its oil in Shiite areas. So they have a Sunni monarchy. It uses its Wahhabi Sunnist religious police to suppress dissent in these very heavily Shiite areas that are producing most of the oil. If those police pull back, does it create the potential for unrest? And if unrest begins to be created, what is the consequence? Also, what is the consequence of the recent arrests in Riyadh? This is something we don't know the answer to. But there is a book that was published a bit over 500 years ago, one of the oldest, in fact, the oldest text of political science by the person who I consider to be the greatest political scientist of all time. And that book is actually a series of letters called The Prince. And it's written by a man named Niccolo Machiavelli. And one of Niccolo Machiavelli's warnings is that a prince, and he wasn't talking to Mohammed bin Sultan in particular, but any prince has to be careful of doing the following. He said that people will sooner forgive you for killing members of their family than they will for confiscating lands, titles, or property. So the fact of him having confiscated all of these assets in the short term may help to boost Saudi Arabia's finances, but there could be blowback in the long term. Many of the people who he had arrested are very powerful people who are part of the Saudi royal family. We don't really know what the consequences of this will be yet. So my view of oil in general is that the political risks are mainly to the upside in terms of price, and that the economic risks are mainly to the downside. So on the downside for oil, you have a lot of things that could potentially cause prices to fall. Those things include the very high level of inventories in oil, which are starting to come down but remain at very, very high levels. The fact that China's economy might begin to slow. You also have a tremendous increase in the efficiency of vehicles, which is limiting demand growth. Essentially, the average car produced this year is 20% more fuel efficient than the average car produced 10 years ago. Since the average car is about 10 years old before it gets replaced, that means that the number of miles or kilometers driven has to increase by at least 2% per year just to keep oil demand stable, which is not great news for OPEC. I tend to think the economic risks are mainly on the downside for oil, but you have these political risks like the ones in Saudi Arabia, and there's many, many other oil-producing countries that could experience political problems, including Venezuela, Nigeria, Algeria, and Angola. The last two are countries almost nobody pays attention to, but Algeria, for example, has a leader, Mr. Bouteflika, who's not been seen in public for 4 years. And he has no succession plan. And Algeria has a long history of civil wars, including a terrible civil war that was fought between 1992 and 2002. Likewise, you also have Angola, where the leader Eduardo dos Santos is around 80 years old, also has no clear succession plan. Angola fought a 25-year-long civil war from 1975 until the early part of this century. So there's a lot of potential for instability that could cause prices of oil to go dramatically higher. Now, a lot of people do hope that U.S. production will replace any problems elsewhere in the world, but I don't think it's going to. And so U.S. production, as we know, had this tremendous increase from 5 million to 9.5 million barrels per day, which helped to provoke the collapse in global oil prices. But if you want to know what will happen to U.S. production going forward, there's one indicator that you should look at. And that one indicator is the Baker Hughes oil rig count. So the Baker Hughes oil rig count, when it falls, it tends to lead declines in production by about 4 months, or about 17 weeks on average. And likewise, when it begins to increase, production begins to rise about 17 weeks later, or 4 months later. So now we have oil prices up around $60 per barrel, and the Baker Hughes oil rig count is not growing. It's actually been falling slightly. That leads me to believe that U.S. production is very, very near a peak at the moment. And so that means that the U.S. and Canada probably cannot compensate for problems that may come about in the Middle East, that could come about in various African countries or in Venezuela or in other major oil producers. So I would brace yourself for some potentially very, very big volatility from the oil markets. Now, I would also like to talk just quickly about our new Bitcoin future. It seems like when I talk to people, it's the only thing people want to talk about now is Bitcoin. So I think I won't probably survive if I don't mention it. To my mind, Bitcoin and gold have a lot of similarities. Both of them are seen as currencies. Gold, of course, is a historic currency. There are some people who still consider it to be a currency of sorts. But one thing about gold, though, is its supply doesn't grow very quickly over time. And so as a result, it tends to rise in price versus other currencies, versus fiat currencies printed by central banks, which, of course, is probably part of the reason why it's such a big part of the culture in the world, particularly in India and here in Southeast Asia. And so if you look at gold versus the U.S. dollar, it went from $35 per ounce in 1968 all the way up to $1,250 today, which is a very nice increase. But of course, that pales in comparison to the increase in Bitcoin, which at last count is 12 million% since 2010. And I don't say that to make you regret not having bought it, but I regret not having purchased it earlier as well. So if you didn't buy it in 2010, I'm right there with you. So what it does is it highlights the tension between two different uses for money. And money can be either a medium of exchange or it can be a store of value. And rightly or wrongly, people treat Bitcoin and gold as stores of value. But they are very, very volatile stores of value if you experience them from the perspective of a currency like the Thai baht or the US dollar. And so Bitcoin has a 70% annualized standard deviation over the last few months. And gold, of course, has a 15% annualized standard deviation. Now, they both can have really big drawdowns as well. Like gold had a 70% drop from 1980 to 1998 against the US dollar. Bitcoin, in its very short life, has already had a 93% bear market and an 85% bear market. So you might think this is crazy. Who would ever invest in something that can collapse like that? And the answer is, well, most of us. If you look at the US stock market, from 1929 to 1933, the Dow Jones Industrials average fell 90%. People still buy stocks. The NASDAQ, as I mentioned earlier, between 2000 and 2002, fell almost 85%, and people still buy technology stocks. In fact, the NASDAQ, as you know, has gone on to new record highs in the last couple of years. It took it 15 years to recover. It only takes Bitcoin seemingly a smaller amount of time to recover. But there's a question of why is it that Bitcoin is so volatile? And I think it takes us back to those most basic lessons of microeconomics that we've probably mostly forgotten. which is that Bitcoin supply is almost perfectly inelastic. So if the price, say, doubles tomorrow, the miners can't really produce much more of it. And if they do produce more of it in the short term, because it's limited to 21 million coins, it means they will produce less of it after they're done producing a little bit more in the short term. So basically, if you have a normal market, where you can have more supply if the price goes up and you have demand shifting, you wind up rising to a higher price, but you also get more quantity. We're in a perfectly inelastic market. It doesn't matter where the price goes. So the prices tend to be much, much more volatile. And we think that explains in part the volatility of Bitcoin. The truth is we have a lot of volatile markets that are very inelastic that trade on our exchange, like natural gas, for example. Natural gas, if the price doubles, well, people still need to buy it in order to produce electricity, to heat their homes, to run air conditioning systems, or to run industrial processes, or to make goods like fertilizer for plants. And likewise, if the price doubles in the very short term, the people creating natural gas or pumping it out of the ground can't produce any more of it in the short term. So natural gas tends to be a very, very volatile commodity. The joke about it is that if you have one molecule too much, the price goes to zero. And if you have one molecule too few, the price goes to infinity. And it seems to be somewhat the same for Bitcoin. Now, as we know, Bitcoin has its own money supply growth. In 2009, it was infinite. And then in 2010, it was 100%. Then it was 50 in 2011. But now it's coming all the way down to just 4% growth per year. And soon it's going to drop below 2% early next decade. And then eventually there will never, ever be another Bitcoin produced again. And so what we have is we have a series of shifting supply curves for Bitcoin. So for example, in 2009, the supply was at 2.5 million, then 5, 7, and 10. And so now it's starting to grow more and more slowly. So as demand rises, we're seeing prices rise exponentially. From 1 cent to 10 to $1 to 10, and now up to 10,000. This graph here is out of date. It shows it at 8,000. Now the price is already over to 11, which would be about here on this graph. And so could it go to 100,000? Could it go to 1 million? Could it go to 0? Any of these things are possible. And so if you look at gold, for example, gold is also mined. 97 million ounces of gold, or about 2.3 metric tons, will be mined this year. Now, thanks to this organization here called goldeagle.com, we know more or less how much gold was mined prior to the year 1900. And then a variety of sources, including the U.S. Geological Survey and the CPM Gold Yearbook, show the estimates of how much gold has been mined every year since 1900. This allows us to calculate the growth in the gold money supply. So when gold money supply is growing very, very quickly, the price tends to be low. And when gold money supply is growing slowly, prices tend to be very high. So the problem for Bitcoin is the price is high in part because supply is extremely limited. And the market knows that, so it's pricing it at a very high level. So one question you can ask, so what could limit the increase in Bitcoin? And so one thing that limits the rise in gold prices, in addition to all this new mining supply, is that gold has a major competitor called silver. And gold and silver are part of this little ecosystem. Where gold prices, if they go up 5 times, for example, which they did from $300 to $1,500 per ounce, that means a lot of people get priced out of the market and can no longer buy gold jewelry. But they can still afford to buy silver jewelry because silver jewelry costs only 1/70th as much. So even if silver goes up 5 times, it goes essentially to 5/70ths of the previous price of gold. And so when we see a rise in gold mining supply, say a 1% rise in gold mining supply tends to drop the price of gold by about 2.2%, and by silver by over 3%. But likewise, when there's a rise in silver mining supply of 1%, we tend to see around a 2% drop in both gold and silver prices. So one thing that could limit Bitcoin's rise is the existence of other currencies. There have been over 1,100 other currencies launched in the last few years. And some of them don't have this constraint of only a certain amount of coins that will ever be produced. In a short term, that may not be to their advantage. But in the long term, it could be advantageous because it makes them useful as medium of exchange. And to my mind, the only reason why fiat currencies like the Thai baht or the US dollar or the euro work as currencies is because people know that they will be worth less in the future. If you think your currency will buy more goods and services in the future than it buys today, then you don't spend it. You hoard that currency. And that's fine if one person hoards their currency, but if everyone hoards their currency, then the economy functions at a very, very low level. And so an economy based on something like Bitcoin would be a disaster, just as the US economy and other economies were a disaster under the gold standard. And so gold also has its own mining cost of production. It's profitable to mine gold at around $700 per ounce from a purely cash perspective. But once you include in all of the corporate overhead costs and as well as the capital expenditures to create new mines, that rises to about $1,150 per ounce. Now, Bitcoin also has its own mining cost of production. That is related to the difficulty of solving its cryptographic algorithm that creates new bitcoins and also monitors transactions on a distributed ledger. But Bitcoin's difficulty, of course, increases exponentially, from a very low level of 1 now up to 1 to the 12th power, 1 times 10 to the 12th power, just in the space of a few years. But there's a very interesting relationship here when you look at this graph that in some ways sort of reminds me of the VIX yield curve cycle a little bit. And so one thing is that when prices rise very quickly, you tend to have a really big rise in difficulty. But then when prices crash, difficulty actually goes sideways for a while the market recovers. And then, once prices start rising again, difficulty rises, but then when it crashes, difficulty goes sideways. So right now we're having this another big spike in prices, and it's looking to like maybe it's getting a little bit ahead of itself. I mean, it is up 1,000% so far this year. So at some point, maybe a correction is overdue. Some people also look at difficulty in terms of the hash rate. The hash rate is basically a different way of explaining the exact same concept. Another thing that concerns me about Bitcoin in the short term is the relationship between the volume of transactions and price. So if you look here, for example, volume of transactions stopped growing and prices eventually crashed. Then with low prices, the volume started rising again and the price rose. Now it's going sideways. The last thing that worries me, and this will be the end of the presentation here, is that you had this huge spike in transaction costs here, which preceded a 93% crash in Bitcoin. Then you had this other spike, which preceded an 83% drop in Bitcoin. Now we're having another big spike. So does this choke off demand and cause Bitcoin prices to at least temporarily experience another crash? So those are my questions. I don't really know the answer, but I'd be very happy to discuss any of these themes or any other economic theme with you. Thank you.
Thank you, Mr. Erik, for giving and sharing us your view on global economics. If anyone has got some question and would like to ask Mr. Erik, it's time to do so. มีท่านไหนสงสัยมีคำถามจะถามคุณอีกไหมครับ
Yes.
Hi, I'll kick things off. So you explained various markets. I just want to start with the States, for example. You mentioned that monetary policy, show your projections, and how much of your thoughts on monetary policy depend on the fiscal policies which might or might not occur in next year. For example, we know that the tax reforms are currently just passed both houses, but there's still a question mark on how far it'll go. In addition, there's also a question in terms of entitlement reform. What is the likelihood of that passing, and how would that affect your calculus in terms of monetary policy in the coming years? Thanks.
Yes, that's a great question. Yes, here we go. It's back on. So the Congress, as you mentioned, has passed a tax cut, sort of, but they have different versions of it from the upper house and the lower house. So they have to maybe, hopefully, reconcile that and then send it on to the president to be signed. We think we're 80% sure that it's going through, but not 100%. if a tax cut goes through, I think that the impact fiscally will be fairly small. The people say, okay, it's going to add $1 trillion to the deficit, which is true, but that's $1 trillion over a long period of time. So about $100 billion per year added to the deficit. So that amounts to about 0.5% of GDP, which is pretty small in terms of stimulus. So most of the change will be for corporate tax rates. The U.S. has among the world's highest corporate tax rates at 35%, and those will be brought down close to the world average, which is around 20%. So one potential impact is a lot of corporations that have been hiding profits overseas because they don't want to pay that very high tax rate will move profits back into the United States. So I think it will tend to have a fairly small impact on the economy, in part because there's this hope that they're going to build new factories and new production centers with this money being brought in. I don't think that's likely to be the case. I think that they'll just transfer the money back into the country. The dollar will then rise perhaps a little bit, which will make the U.S. less competitive. So it will kind of come out the other side. But to the extent that it does stimulate a bit more economic growth, it would encourage the Federal Reserve to raise rates at a faster pace than they might otherwise do, which in turn could flatten the yield curve out further and eventually, as we saw, provoke problems both in terms of credit spreads and in terms of volatility.
Thank you.
In your opinions, Erik, when is peak oil, and what's your rationale about that? And the second question is, what is your future outlook on coal?
Okay, yeah, sure. So in terms of oil, I think we're probably closer to peak oil than people realize. And so the thing is, to my mind, peak oil, a lot of people say, well, it's been discredited because there was a lot of concern about peak oil 10 or 12 years ago, and now we're above the previous peak of oil. But what I would argue for oil is that peak oil is always fairly accurate, but it's like a series of overlapping distributions. There's a lot of different ways you can view it. So one way you can view it is oil on land peaked, or oil where you don't have to drill underwater. In just traditional drilling, peaked a long time ago, like I remember, like sometime during the 1990s, and it's declining in a very orderly fashion. But then we had another distribution on top of that. There was offshore drilling. And so offshore drilling is still possible, but it's kind of like Bitcoin. We saw its mining cost of production going up. Well, the cost of offshore drilling is much, much higher than just drilling a shallow hole in land. And then lastly, you have fracking in the U.S., or hydraulic fracturing. And that's created this spurt of growth in the U.S. But the thing about fracking is that it tends to create very sharp spikes that come down very quickly. So it's like a normal distribution, but one that's very compressed. And so the thing is that technology that's been employed in North America could be employed in many, many other countries. So I don't know that it will necessarily lead us to a short-term peak, but I'm getting a little bit nervous that we can continue to grow production in this manner. The other side of it is that there are more and more people, including people in major oil companies like at Total, for example, that are becoming concerned about peak oil demand. And so whether demand peaks depends a great deal on how much progress we make towards electric vehicles, towards hybrid vehicles, towards batteries, and other technologies. But I think those technologies are advancing very, very quickly, which brings us to coal, because batteries and alternative energies like solar and wind are mainly a threat first to coal and as a source of electrical generation. So solar panels are coming down in cost at a fairly steady pace. And so I think that fairly soon solar will be fully competitive with coal. And so I think coal could be eliminated as a resource within, say, the next 25 years or so. I think we'll still be using a lot of coal in 10 years. But as we move into the 2030s and 2040s, I think coal is probably not the field to be in. Because I think that solar panels, wind energy, and other sources of alternatives, combined with very rapid advances in storage technology from lithium batteries, from other sorts of batteries, will create very different, less centralized electrical grids, and that will put a lot of the coal producers out of business.
So
Your thought on something like Peabody turnaround, for example,
Your thought on Peabody's, right? It's turned around back from bankruptcy and went back, I think, with the price jacking up so much. Any thought of the futures of turning around of some companies like Peabody that have 130 years old history?
Yeah, well, I think it depends in part on their adaptability, whether they're able to adapt to a very different environment. It seems to me like when it comes to commodities in general, whether it's coal or oil or industrial metals, we're kind of like in the eye of a typhoon. Part of the typhoon passed over the commodity markets, depending on the market, from 2011 to 2015 or 16, when prices of most commodities, including coal, fell very dramatically. Then, in the last 12 months, everything has rebounded. So people are like, great, good, the bear market's over. But I have a feeling that the more accurate analogies are kind of in the eye of a hurricane or the eye of a typhoon. And that there's another side to the storm that's going to start blowing over. That could be potentially very bad news for a lot of producers. So if I were a coal producer, I would want to be using futures markets to hedge my exposure as far out as possible, in order to lock in the current prices.
Thank you. While we wait for the next question, I just want to continue. You were fairly bullish on Europe, so just want to get your take on, for example, a lot of the underlying structural issues which caused the European debt crisis is still there. There's not been any significant pension reforms. Labor is still fairly inflexible. We can still see, for example, in Greece, it's just a matter of kicking the can on. Why are you so bullish on it, even though the structural reforms have not been made?
Yeah, so if I had to sum up the reason why I'm bullish in just two words, zero rates. So the thing is that when you have very high debt levels, and so I think you're absolutely correct, there has been no reform whatsoever in most of these European countries. Like some of them have liberalized their labor markets a little bit, but that's about it. They have not dealt very well with their debt issues at all, including Greece most obviously. But also countries like France and Italy are continuing to ramp up their levels of debt as we speak. And so all of this is made possible by zero interest rates. When you have zero interest rates, you can manage a very, very high level of debt. And so that's basically what the Europeans are doing. But with zero interest rates, that can provide economic growth for at least another few years. I think the real risk to Europe will be the next time the ECB begins tightening policy. But I don't anticipate I think they'll bring QE to an end at the end of next year, but that won't have very much impact. I don't think they'll actually start raising rates until probably after 2020, or at least late 2019. But once they start raising rates, then things change. Then the lack of structural reforms will become more evident that that's still a problem. But I think they've bought themselves a few really nice years.
Okay, thanks. Sorry, can you just get this so we can record? If you could just introduce yourself first before you ask a question.
Okay, my name is Nat. Can you comment on India and Japan economy?
Yes, absolutely. So I remain very optimistic about India. I didn't put a lot of slides in the presentation about India, but one reason why I'm very optimistic about India is that they have very little debt. India's debt ratios are very low. So they're one of the few countries in the world, along with Germany and Israel, that have, I would say also Thailand, that has relatively low levels of debt. So that, I think, is very good news for them. India also has a big labor cost differential versus the rest of the world, which still plays to their advantage, I think. Will still encourage them to grow. Lastly, India, even though we classify it sometimes as an emerging market, it's not, as you know, a commodity producer. So if commodity prices crash and if China begins to slow down, that's of almost no importance to India at all. In fact, it could even be beneficial. These lower commodity prices would tend to reduce the cost of living in India and allow the central bank to maintain an easier monetary policy. And in the case of potentially lower oil prices, that would also be beneficial because it would shrink the government's budget deficit since they're subsidizing the price of oil domestically. I think the biggest risk to India might be problems in Saudi Arabia. There were a huge rise in oil prices that would probably be quite negative for India. But overall, I'm very, very optimistic. With respect to Japan, I would say in many ways it's a lot like Europe in the sense that it has not really made as many structural reforms as people might have hoped. Japan, I would argue, Abenomics has been very, very successful. They have gotten their economy growing again. They've had the best growth in the last, say, 4 years or so that they've had since the 1980s, which isn't saying much, as we know their economy went sideways for 25 years. But they are nevertheless having very nice, strong economic growth, and I think that that will continue. The Japanese, of course, have a lot of headwinds. They have massive levels of debt. The US and China and Europe are at 250% debt to GDP. Japan is closer to 400%, which is a tremendous mess. But there too, even though they're not reducing their debt, they're financing it at negative interest rates. So it's all possible so long as the central bank doesn't tighten monetary policy. I think the risk to Japan is that they eventually allow their currency to appreciate. A strong appreciation of the yen could choke off economic growth there. But I'm quite optimistic that Japan will have at least another 12 or 24 months of nice growth. But they have not been able to reduce their budget deficit, though, as much as they might have hoped. A budget deficit when Abe came in was around 10%. Now I think it's still around 5 or 6%, which is still too high. I would like to see them increase the value-added tax further, but that's politically very, very difficult. But if they can reduce their budget deficit and maintain an easy monetary policy, I would maintain a pretty bullish stance on them.
Thanks. Just shifting to a region that I think is of importance to a lot of the audience here, China. You're fairly cautious in China. However, they've been making, I guess, a lot of investment into infrastructure. Here in Thailand, for example, the Eastern Economic Corridor under the aegis of the One Belt, One Road project is expected to generate about $44 billion alone in Thailand, and of course trillions worldwide. What is your thoughts in terms of this grand expansionist infrastructure and easy credit program, coupled with a much more robust, I guess, almost militaristic expansionist policy into the South China Sea and so forth of China, and how does that reflect in your calculus of you being cautious about China in the coming decade?
Right. I think that the One Belt, One Road initiative is very interesting to watch. It is an enormous expenditure. My fear for China is that it's going to add more and more to their already high levels of debt, and that they might lose enthusiasm for it if their domestic economy begins to slow down. It's clear to me that China's geopolitical position is they want to expand their influence. So One Belt, One Road obviously moves through this area of the world down into Africa and into Europe. For the moment, I think the Trump administration is sort of playing into their hands in the sense that the Trump administration is retreating from Asia. So China is sort of moving in to fill the void. But that policy may not be permanent. And the Trump administration is very unpredictable in their policies, too. So it'll be interesting to see what, if anything, the U.S. tries to do to counter China and to make life difficult. Under President Obama and President Bush, our strategy was basically to surround China with unfriendly countries, Japan, South Korea, Taiwan, Vietnam, Thailand, India, to sort of contain their expansion. But the U.S. has had this very complex foreign policy. Everybody talks about China's strategy, which is very clear. People rarely talk about what America's strategy is. And America's strategy, to my mind, is a lot like Great Britain. Great Britain wanted to, during most of history, wanted to make sure nobody dominated Europe and came to control the continent of Europe. America is very afraid that somebody will come to dominate Eurasia. That will pose a threat to the United States. After the Second World War, we spent several decades trying to contain Russia and China simultaneously. And after the Vietnam War, we found out it was too expensive. So we kind of flipped China to our side to contain the Soviet Union. Then after the Soviet Union collapsed, we went back to trying to contain Russia and China simultaneously. But I think after being exhausted with the wars in Iraq and Afghanistan, the United States is now once again reflecting on which one do we contain. And there's a conflict in Washington over what to do. The sort of traditional foreign policy establishment wants to still try to contain Russia, whereas Donald Trump and Steve Bannon want to flip Russia onto our side in order to contain China. Or maybe Russia has flipped the United States onto its side, or something has happened. But there's clearly a lot of movement in foreign policy, and when you have a lot of movement in foreign policy, I think it creates really big risks in markets.
Thank you. Yeah, you could just introduce yourself and say where you're from before you start a question.
Okay, my name is May, and I want to ask a question about China. Now China doing something called cashless society. Do you think that it can affect the number of GDP? Because you say that the debt of China is very high.
Mm-hmm.
So I just wanted to think that when China, I mean most because China is like very large, right?
Mm-hmm.
So there are a lot of money that outside government eyes.
Right.
So it's like they're doing like cashless society and can bring everything inside the system. So can it be like affect the number of GDP in a good way?
Oh, that's a good question. Yeah. So I guess China, you're pointing out, has a pretty significant black market or sort of off-the-books economy. And if that were brought on the books, would it impact the size of the gross domestic product and the debt ratios? That's a good question. I don't truthfully know the answer. But I guess all countries in a way have black markets. So it's a question of how big is the black market relative to the rest of the economy. For example, drug dealing in every country is off books, yet it happens seemingly everywhere in the world. And generally, the more control a government tries to exercise over the economy, the more of it that will get pushed into the black market. Truthfully, I don't have the tools or the information or the statistics necessary to sort of know how to adjust China's economic figures to reflect that. I don't know. I guess you could argue it either way. You could argue on the one hand that yes, if you included China's black market, their debt ratios would be much lower and the economy would look bigger. On the other hand, you could also argue that maybe the size of the economy is also exaggerated as well. And so maybe it's even worse than it looks in terms of debt ratios. But the truth is I don't really know. It's a good question, but it's a hard question to answer.
I guess I'll fill in another one. Saudi Arabia and oil. So what are your thoughts in terms of the opposing view in terms of, some political scientists like Ian Bremmer have mentioned that perhaps it's a positive thing with the arrest of all these, depending on which side you are the oligarchs or the princes, in terms of the grassroots being supportive of them. At the same time, because in addition to all that you mentioned, they're erasing a lot of subsidies which the people of Saudi Arabia have been used to. So gas is going to go up a lot more expensive. Is it a positive thing, at least in the short run, that you arrest all these seemingly corrupt figures, and can that kind of be used to gel the society together, especially with instead of the Wahhabist, religious methodology which is being used today?
Yes, that's a great question. I think that in the short term, the answer to that is a resounding yes. You rightly point out that this is very, very popular in the short term. But the problem is, as you also point out, they're removing subsidies. So the cost of a lot of things like oil and gas that had been extremely low are going to begin to rise. And so as that happens, people might forget about the arrest and whatever positive feeling they had about seeing rich people brought to justice. And they might start getting nervous. And on top of that, you have the foreign investors who are looking at the Aramco IPO, and they see these arrests happening with no due process of law. And I think that also makes them nervous about investing in Saudi Arabia, which may make it harder for the Saudi government to raise outside capital as well. And so if that impairs economic growth, I think the short-term rise in popularity is not going to last too much longer. In a year or two, people won't care if the princes were arrested, but they will care if their gas and electricity bills and their oil bills are significantly higher than they are today.
Okay, my name is Pagwan. Well, there are more and more people start talking about the next financial crisis.
Right.
I know you mentioned one thing, one maybe symptom problem with a country like China. But in your view, what would be the next likely financial crisis coming from any country or any bubble to watching for? And what is the time frame in your view?
Right. Well, so I think that China poses a major risk to its own economy as well as to the economies of all of the natural resource producers in the world. Its impact in terms of the U.S. or Europe or other economies is a little different because we don't really export that much to China. It depends on the country. Like Germany exports a lot of, say, industrial equipment. But I think China is a very, very big risk, and I would not be surprised to see some sort of crisis start there in the next, say, 5 years or so. In terms of other countries, I think you're starting to see this huge rise in equity markets around the world. And so markets tend to overshoot. They tend to go too far. They were too undervalued before. Now they can become too overvalued. This could be a bubble that's developing. And then you have Bitcoin. And I don't mention this because we're launching a futures contract, but Bitcoin right now is worth $180 billion market cap, which is very, very small in an $80 trillion global economy or $75 trillion global economy. So if Bitcoin goes to zero tomorrow, it doesn't really hurt the global economy. But imagine if it goes up 10 more times to 1.8 trillion, or if it goes up 100 more times, so that it's, say like an $18 trillion asset, and then it collapses. What could happen is, and the thing is, I get this sentiment talking to people in every country that I visit. I was on the beach in Australia last week, and people around me sitting on towels were talking about Bitcoin. I was in Vietnam yesterday, and somebody came up to me and telling me that her grandmother was now wanting to buy Bitcoin. My Spanish instructor, I consider the greatest contrary investor of all time, sent me, she used to recommend technology stocks in 1999. She's talking about Bitcoin. So imagine Bitcoin keeps going way up, and lots of middle class or not even middle class people around the world put their money into it. And then the price crashes, and so you have a few people at the very top who make a ton of money, and then you have widespread losses for everyone else. How does that impact macroeconomic demand? We could have a cryptocurrency crisis in 2020. It's hard to say. There's a lot of possibilities. Equities, traditional assets. It could be a monetary policy mistake by the Federal Reserve or other central banks raising rates too much. But I think that eventually we will have a crisis. And I think that the likelihood of a major crisis outside of China in 2018 is very low. But for China, I'd say it's maybe 30%. And as we move to 2019, I'd say 50-50 for China and maybe 10% for the rest of the world. And then after 2020, it depends a lot on what happens with cryptocurrencies, with interest rates, with monetary policy. But there will almost certainly be another crisis someday. But knowing exactly where it will be is difficult.
Hi, my name is Warmo. I would like to ask, I would like to get your point of view about the relation between the economy and the Bitcoin growth. For example, like Venezuela. Now we know that several years Venezuela was suffering from the hyperinflation, especially the last couple months. And it seems like the inflation rate, the growth rate of the inflation is slowly, and many media was reporting that it's like the side effect that people starting to interesting on Bitcoin, and they use that thing as a alternative way of surviving. Also, just want to get your point of view. What do you think about this relation? This is the first question. And another one is, what do you think that the stock market of the Venezuela stock market was also making an all-time high record. It's like overshooting while the economy was still not that good. Is there any response? I mean, is there any relation between the stock market with the growth on people attention on the Bitcoin? Yeah, that's all.
Yeah, no, those are great questions. So, I think with Bitcoin, it's very interesting because the mathematics behind Bitcoin were first published in an academic paper in 1992. And for 17 years, they sat with no application whatsoever until in 2009, at the same moment as the Bank of England and the Federal Reserve began quantitative easing, suddenly Bitcoin came into existence. So I think that when people lose confidence in fiat currencies, they're more likely to use Bitcoin. So to that extent, I think, I don't think Bitcoin is strongly influenced by Federal Reserve monetary policy, but I do think that in countries like Venezuela, the attraction is very obvious. Now, with respect to Venezuela's markets, which I have to admit I don't follow too closely, I follow the political situation in Venezuela to the extent it may impact oil and oil prices. With respect to their equity market, my only comment would be that you may want to adjust the equity market's performance for inflation or to redenominate it into another currency. And so the thing is, Venezuela has its own completely fictitious exchange rate. That's just a complete lie that nobody, including not least of all the Venezuelans, believe. But there's a website called Dollar Today, which is DOLAR, that has the real exchange rate that's actually being traded in the black market in Caracas and elsewhere for the bolivar versus other currencies. And my guess is if you adjust their market for the real exchange rate and you say view it in dollar terms or any other currency terms, their equity market's probably not looking so hot.
Hi, my name is Remy. I just have a quick question. I guess it's more towards gold and Bitcoin. I think that was a very good, comparison in terms of what's happening. But as we know, gold is always considered as a safe haven. And you just mentioned also even grandmothers are looking to buy Bitcoin. So my question would be, would the safe haven be changed from gold to Bitcoin? I don't know if Bitcoin is safe haven in itself right now, or it's just a big rush going for, I'm not, so that I don't miss the train,
Yes, exactly.
Something like that. So my question to you is, gold has been trading sideways.
Mm-hmm.
So what do you think, how would that change the gold status in our economic market right now? And what do you see gold going forward? If Bitcoin really does go up to that level, what happens to gold?
Yeah, well, I have this great chart I should have put in the presentation, but I did not. And it shows that gold has an extremely high correlation with the Fed funds future. So the future, especially the Fed funds future 1 or 2 years forward, has a very high correlation, or say a very negative correlation of negative 0.6 with gold. So essentially, if the market expects the Fed will raise rates more than it currently expects, gold prices drop, and vice versa. I have not seen I've heard a lot of people ask your question. A lot of people say Bitcoin is negatively influencing gold by taking demand away from gold. And I know that there are people in the precious metals industry who are concerned about that. I have not seen any evidence that that is actually the case yet. Now, I'm not saying it isn't the case, but what I would say, though, is that that 97 million ounces of gold that's going to be produced this year at $1,250 per ounce, that's about $120 billion market value for just 1 year's mining. So Bitcoin has a total market cap of around 180 billion. And if you take the existing outstanding stock of gold, all the gold that's ever been mined, it's worth almost $7 trillion US. So Bitcoin is just a tiny, tiny drop in the bucket. But as I said, if Bitcoin goes up another 10 times to 1.8 trillion, then it gets to about a third of what gold's worth. And if we go up to another 100 times, I know sounds ridiculous, because it would mean $1 million per Bitcoin, but I mean, hey, it went from like 200 to 11,000, so why couldn't it go from 11,000 to 1 million? I don't know. I mean, I mean, it's crazy, right? Because it depends on how many greater fools are there out there who will buy it, at a higher price in the future. And the truth is, we don't know. It's like the world's first global tulip bulb. If it gets to $18 trillion, then it just dwarfs gold in terms of its value. So it could presumably have a negative impact. On the other hand, when Bitcoin eventually crashes, if it goes up really high and eventually crashes, and then causes central banks to lower interest rates to offset the negative impact on perhaps billions of middle-class people worldwide who got involved in this, then in that case, gold prices could wind up soaring. But that might not happen until maybe after 2020. And in terms of our VIX yield curve cycle, if the Fed continues to raise rates in the short term, that's bad for gold. But if they put the economy into a recession, the Fed will have to go back to zero rates. And the next time they start chopping rates down to zero, also very good for gold. But that probably won't be in 2018. I would expect another year of kind of sideways, unspectacular, maybe even slightly lower gold prices in 2018. That would be my guess.
So you're saying that it will still be a safe haven?
Oh, gold? Yes, gold will still be a safe haven. And unlike Bitcoin, if there's a massive solar flare or some sort of like nuclear war that knocks out the world's computer systems or some sort of virus that destroys the world's computer systems, your gold will still have value. Yes, if we run out of electricity, gold will still have value. I don't know what you'll do with your Bitcoin in that case.
No, they actually, I don't know, I'm not too much into Bitcoin as yet. I think it's just a hype topic and you just want to see what is it, should you invest, should you not, and you're just doing that research. But they're actually talking that if Bitcoin does, if the digital economy does break down or something happens, there are these hardware wallets that you can keep and you can still retain the value, just similar to a tangible gold. Is that true?
Yeah, so people can and are putting it into cold storage. That's right. I have colleagues who've done this, and you have to be really careful about doing this too. I have this colleague, for example, who she opened up a bank account, I think in Latvia or Lithuania. She transferred money to it, and then she bought coins on Coinbase, but I guess she didn't do it quickly enough, and so she has like 30,000 euros missing. So it's sort of a wild west. And so, yes, you can put it into cold storage, but you have to buy the coins and put them on the cold storage device very quickly. You have to keep the cold storage device someplace safe and not forget where it is, etc., in order to get those back at some point in the future.
Just the last question. We talk about Bitcoin futures, which is going to be launched. I didn't see you talk much about the futures trading. So a little bit of information about how it's going to work and why do you think that this will maybe help the middle class more, I guess? People who are not who really want to get into Bitcoin but are still questioning whether they should get it now. Is it too expensive? Is it going to be a crash? Or into the futures, so it can just reflect a little bit more of futures.
Yeah, so I don't think in general futures are really a great idea for the middle class, irrespective of product. The Bitcoin future is going to be based on 5 Bitcoins. And so we'll have, 5 Bitcoins currently has about a $55,000 US market value. And it's going to have very high margin requirements, about 35% from the exchange. But brokers are likely to put additional requirements on top of that. So it's almost going to be like a fully funded future, as opposed to, say, our government bond future. You could put up 2 or 4% of the capital and have a position. The part of the rationale behind it is that up until now, there's no way to short Bitcoin. So if you are an owner of Bitcoin and you want to lock in your profits, you could do that by shorting the futures contract. We're also seeing a lot of interest on the part of people who wish to gain exposure to it, who are professional traders of futures markets, including institutional investors like hedge funds. I wouldn't argue that the futures product itself is for the middle class. If you are sort of more traditional middle class investor, you could do what I did, which is to buy it through an ETF like GBTC, which trades on NASDAQ in the US, which is sort of like a closed-end Bitcoin ETF. You could also do it directly through the various exchanges. I think there are maybe 10 major exchanges on which you can trade Bitcoin, 4 of which are part of our reference rate. We have a 4-exchange reference rate that knocks out the highest and lowest prices and takes the average of the middle to sort of help prevent market manipulation of our future and its closing value. But, again, I wouldn't say the futures in general are necessarily for the middle classes. They're more for professionals and for people who can have the financial exposure without having to worry about any consequences to their overall well-being. Yeah, more for hedging, yeah.
Okay, I just want to ask this question out of my curiosity about Bitcoin. As of now, a lot of governments still have caution against Bitcoin. So why you made Bitcoin as one of your products?
Well, so we made it as a product mainly because of demand on the part of our investors. So we hear tremendous demand from all of our brokers to have a product on Bitcoin. About 1.5 years ago, we launched the Bitcoin reference rate, which I mentioned references 4 different exchanges. And so part of the reason is that investors want to have a product that can be settled in US dollars. So it's a US dollar settled contract rather than a contract settled in Bitcoin itself. So it's not physically deliverable, if you will. And we feel like we can offer the product with very high margin requirements. And the margin requirements on our exchange always vary inversely with volatility. So very low volatility products have low margin requirements, and very volatile products have much higher ones. So we feel like we can offer it safely to investors in a way that has, with futures contracts, if you lose money, you have to post more margin at the end of that same day. So we think that the futures market can behave very responsibly. And the truth is, we've had a lot of different products over the years that have been in bubbles. Like silver, for example, went from $4 an ounce in the late 70s to $50 and then came back down. It was a huge development for silver investors, but the futures market functioned very well. Just like the futures market functioned very well during the 1987 stock market crash, during the decline in 2000 to 2002, and during the most recent financial crisis. So we feel like the sort of mechanism of futures with daily settlement, posting of margin, etc., sort of makes it so that you can trade it more safely than you could otherwise.
Final question, I guess, is maybe it's also to Joel. What's the best way for a new investor to learn more about the futures markets, for example? Because as you know, through Phillip, that's the only legal way you can trade CME futures. So, but a lot of people in the audience might be wondering, what's the best way to perhaps learn more before they decide whether or not this is for them? Perhaps you could speak a little bit about the resources available for, I think, investors and traders of all stages, right? Whether you're a beginner, you're intermediate, maybe you're advanced.
Yeah, I'm not sure if you're aware, we do have an educational website called CME Institute, where clients, especially the retail clients, can log on, and there's a lot of tutorials and webinars that customers can begin with. And we also have futures fundamental for men on the street who doesn't have any ideas of what futures is. They can go through the Futures 101 to understand the market. Then of course we do partners with our brokers in the region like Phillip Futures to conduct some of the training session. But I believe for the basic Futures 101, all the brokers are already offering the training, awareness training for the clients. Once a while, if let's say there is a request from institutional clients like fund managers, we could also organize some of the specific training on using some of the specific product, like for example the interest rates futures. We have been conducting the US Treasuries training for the past 2 years in the region. If let's say any one of you are interested in understanding how you can use our US Treasuries futures to hedge your duration or portfolio, then you can reach out to Phillip Futures. We can always organize a session for the interested clients.
Thank you.
All right.
ขอบคุณทุกท่านนะครับแล้วขอบคุณมิสเตอร์อีกรอบนะครับขอบคุณต้อนรับขอบคุณบริษัทครับ
Thank you.